What if I told you Ram is about to blow up the entire car market with one shocking announcement? For years, the automotive market has been dominated by a few key players, but now, Ram, one of the top truck manufacturers, is making a move that could shift everything. A decision that's not just going to affect their dealers, but could change the way consumers buy trucks forever, and no one saw this coming. So, what's really happening at Ram? How will this move affect truck prices? And why should you care if you're looking to buy a vehicle in the next year? Stick around because what Ram is doing next could save you thousands or cost you big time. The sudden shift. The automotive industry is facing a monumental shift, and Ram is at the forefront. Stellantis, the parent company of Ram, has just unveiled a strategy that few could have predicted. A sweeping reduction in manufacturers' suggested retail prices across their lineup, with certain models seeing discounts of up to 35%. Even more astonishing, some of their trucks are dropping in price by as much as 60%. This is no routine promotional sale. It's a transformative decision that could alter the landscape of the automotive market, changing how vehicles are priced, sold, and perceived. What's driving this dramatic action? The answer lies in surplus inventory. Over the past couple of years, Ram dealerships have struggled with an abundance of unsold 2022 and 2023 models. These vehicles have been sitting idle on lots, taking up space and racking up carrying costs. For Stellantis, clearing this excess stock has become an urgent priority, and their solution is nothing short of radical. Rather than let these trucks linger, the company has chosen to cut prices sharply, making them more attractive to buyers and clearing the way for new models. But this move isn't just about stock clearance. Stellantis is making a statement. By cutting prices so drastically, they are signaling a fundamental shift in their approach to pricing and competition. It's not just a temporary measure. It's a strategy designed to redefine how Ram and possibly the entire automotive industry operates. For competitors, this move raises immediate questions. How will other manufacturers respond? Can they afford to match these discounts? And what does this mean for the long-term pricing structure in the truck market? The dealer dilemma. Dealers are now navigating a complicated and challenging new reality. Imagine investing heavily in a vehicle priced at $60,000, only to see it discounted to $38,000 a few months later. This scenario, though shocking, is becoming a daily reality for Ram dealers across the country. The unsold 2022 and 2023 inventory represents more than just lost revenue. These vehicles are accruing interest, tying up valuable lot space, and creating financial pressure that cannot be ignored. For dealers, the decision from Stellantis to impose sweeping price cuts is both a blessing and a burden. On the one hand, the reductions help move inventory. On the other, they come at a significant cost to dealer margins and long-term profitability. It's important to understand that these price reductions are not voluntary. Stellantis has mandated them, leaving dealers with little choice but to comply. For certain models, the price drops exceed $20,000, an extraordinary cut that would have been unthinkable just a few months ago. While this approach clears the lots and makes room for newer models, it also raises concerns about the sustainability of such steep discounts. Dealers are caught in the middle, trying to balance immediate financial losses with the potential for increased volume in future sales. A new pricing paradigm. When was the last time an automaker cut prices by 60%? It's an almost unheard of move, yet that's exactly what Stellantis is doing. By slashing MSRPs across the board, some by as much as 35%, Ram has turned the conventional wisdom on vehicle pricing upside down. Older inventory in particular is seeing unprecedented discounts, creating a rare opportunity for buyers to purchase high-quality trucks at a fraction of their previous cost. This isn't just a short-term sale, it's a deliberate strategy to reshape the marketplace. These reductions are redefining consumer expectations. Traditionally, models like the Ram 1500 were considered premium vehicles with price tags to match. Now, these trucks are more affordable than ever, potentially reaching an entirely new segment of buyers. For consumers, it's a windfall, but for the industry, it's a seismic shift that other automakers can't ignore. Ford, General Motors, and other competitors now face intense pressure to respond. They must either match Stellantis' aggressive pricing or risk losing market share. This could spark a pricing war that fundamentally changes how trucks are valued and sold. The consumer impact. For buyers, the new pricing structure is a mixed bag. While some consumers benefit from lower costs, others, those who purchase vehicles before these cuts, find themselves at a disadvantage. Imagine buying a truck for $60,000 only to see it discounted to $40,000 just a few months later. These customers now face negative equity, where the remaining loan balance exceeds the vehicle's market value. This financial burden can create serious challenges. Buyers who plan to trade in their vehicles may find they owe far more than their trucks are worth, locking them into loans they can't easily escape. Beyond the financial implications, there's an emotional toll. Customers who once felt confident in their purchase may now feel buyer's remorse. For those who believed they were making a sound investment, the sudden price drops can be a bitter pill to swallow. The trust they placed in the Ram brand may waver, raising questions about the company's long-term reputation. For Stellantis, maintaining customer loyalty amid these sweeping changes will be a critical test. A ripple effect. The ramifications of Stellantis' pricing strategy go beyond immediate sales. By setting a new benchmark for affordability, Ram is reshaping the competitive landscape. Other automakers will be forced to adapt, potentially triggering a wave of similar discounts. This race to the bottom could transform the truck market from a premium, high-margin segment into a more cost-driven battleground. As prices drop, manufacturers may need to find new ways to differentiate their vehicles, perhaps through innovative features, enhanced technology, or superior service packages. In the months ahead, the industry will closely watch how consumers respond. If Stellantis' gamble pays off and sales surge, other automakers may follow suit. If it backfires, it could prompt a reevaluation of the entire pricing model. Regardless of the outcome, one thing is certain: the automotive market is entering uncharted territory, and Stellantis' bold decision will leave a lasting impact. This isn't just about clearing out old stock, though, or offering a temporary deal. Stellantis' decision to drastically reduce MSRPs is a calculated move to change the way trucks are priced and sold. It's a strategic play designed to reposition Ram within a competitive market, challenge long-standing norms, and set a new standard for affordability. As competitors scramble to respond and consumers navigate the changing landscape, the industry as a whole is being reshaped. Stellantis has taken a bold step into the future of automotive pricing, and the ripple effects will be felt for years to come. Competitors react. Here's where it gets really interesting. What will Ford and General Motors do when Ram slashes prices like this? The dramatic price cuts from Ram are not just a ripple in the pond of the truck market. They're a massive wave that will likely send shockwaves across the entire automotive industry. Ford and General Motors, two of the biggest players in the pickup truck segment, are now faced with a challenge they can't ignore. As Ram cuts prices by as much as 35%, their competitors will have no choice but to follow suit if they want to remain competitive. Ford's F-150 and General Motors' Chevrolet Silverado are the two most popular trucks in America. For years, they've been able to command hefty price tags, and consumers have been willing to pay them, partly because they are the established brands in the truck market. But now, Ram has thrown down the gauntlet with their price reductions, and the question remains: can Ford and General Motors maintain their prices, or will they be forced to lower their own? The decision to lower prices is not a simple one for these automakers. A price cut could have profound effects on their margins, which are already under pressure due to rising production costs and supply chain issues. Ford and General Motors have invested heavily in their trucks, both in terms of technology and luxury features, which have driven up the cost of these vehicles. For years, both companies have worked to position their trucks as premium options with high-end features and advanced technology. But now, Ram's aggressive pricing strategy could make those premium trucks look overpriced to consumers. If Ford and General Motors do follow suit, it could trigger a full-scale price war. While this might seem like a good thing for consumers in the short term, the long-term implications could be disastrous for both the automakers and their dealership networks. With prices slashed across the board, the consumer perception of value could shift, making it harder for these companies to maintain the premium image they've worked so hard to build. The risk of a race to the bottom in pricing is very real. In the automotive industry, competition is fierce, and pricing is one of the most powerful levers that automakers can pull to gain market share. But if every truck maker is offering their products at the lowest possible price, they will all end up competing on price alone, with very little room for differentiation. The once highly coveted Ford F-150 or Chevrolet Silverado could end up looking just like any other truck, and the result could be a downward spiral for all brands involved. But Ram isn't just disrupting its competitors, it's shaking up the entire dealership model, and that's where things get even more complicated. Surviving the fire sale. let's get back to the pressure that is mounting on dealerships, because there is something we just got to talk about, especially those that rely heavily on the sale of Ram trucks. With the fire sale that's about to hit, dealerships are struggling to keep up with the demand for discounts while trying to make a profit. Ram's aggressive pricing strategy is forcing these dealers into an incredibly difficult position. On one hand, they have to move stock quickly to clear out old inventory and make room for the next generation of vehicles. On the other hand, they still need to ensure they don't lose money in the process. Dealers are finding themselves in a precarious situation. Many are facing an influx of new inventory, but they're also sitting on unsold stock from the previous year. For example, Ram 1500s from 2022 and 2023 are still sitting on lots. And while Ram is pushing these dealerships to sell them, it's hard to move vehicles that are priced too high compared to the fresh new models with massive price cuts. The challenge is especially tough for those dealers who have already invested a significant amount in these older models. The longer they sit unsold on the lot, the more interest they accrue, adding to the financial burden. With some trucks priced in the $60,000 to $70,000 range, it's a tough sell, especially when Ram is now offering the same models for significantly less. This price drop is not just about lowering the sticker price, it's about getting dealers to lower their expectations as well. Ram is offering additional incentives, including cash rebates and special financing deals to encourage dealerships to sell older models at a loss. This tactic may help move trucks, but it also cuts into dealership profits. Dealers now have to make a choice. Do they stick to the manufacturer's suggested retail price and risk holding onto these vehicles indefinitely? Or do they follow Ram's lead and lower prices, potentially at the cost of their own profitability? This is where the dilemma lies. Lowering prices is one thing, but what happens if the dealers lose their shirt on each sale? With so much inventory stacked up and the pressure to sell, dealerships are being pushed to take huge risks just to stay afloat. And with Ram's offering of monetary incentives, dealers are encouraged to sell their old stock at lower prices. But this is a short-term solution that could leave them financially strained. In the long term, this constant cycle of price cuts and profit losses will only harm the dealership model. Dealers could be left with little margin for error, and as these price wars continue, the question arises: how sustainable is this business model? Can dealerships afford to keep selling trucks at a loss just to maintain their relationship with Ram and other manufacturers? And this leads to a major shift in how cars are sold, but there's an even bigger factor at play: the financial pressure. Who's really paying? What if I told you that the real cost of these massive discounts isn't coming out of Ram's pocket? It's coming from somewhere else. In reality, it's the dealers who are bearing the brunt of these price cuts. While Ram and Stellantis may appear to be offering incredible deals, they're not the ones directly taking the financial hit. Instead, the cost is being passed onto dealerships in the form of incentives and special interest rates. These incentives are designed to push dealerships to lower their prices and move inventory, but they're also putting additional financial pressure on already struggling dealerships. Stellantis is incentivizing dealerships to sell older inventory by offering back-end money, meaning the dealers are essentially being paid by the manufacturer to sell these vehicles. This doesn't mean that Ram and Stellantis are losing money, but it does mean that they're shifting the financial burden onto the dealership network. While these incentives can be helpful in the short term, they come with their own set of challenges. Dealerships are being asked to sell older, less desirable vehicles at steep discounts, and they're being given cash incentives to do so. But what happens when this becomes the norm? How long can dealerships survive on these slim margins, especially when every new model is priced to move quickly and the incentives keep coming? The long-term implications of this strategy are unclear. While it might seem like a great deal for the consumer, it's not without cost. Dealers who rely on selling at full price may be left scrambling to stay profitable, and some may even be forced to close their doors if the financial strain becomes too much. So what happens when dealerships can't keep up with the sales pressure? Here's where the real story unfolds. Trust and loyalty issues. What happens when the dealerships lose trust in the brand they're supposed to sell? The truth is, it's happening right now. As Stellantis pushes its dealerships to sell vehicles at a loss, many dealers are starting to lose trust in the brand they're supposed to represent. There are reports that a growing number of dealerships are frustrated with Stellantis' handling of the situation. In fact, some dealers have gone so far as to say that if they had the option, they wouldn't take a Stellantis franchise at all right now. Dealers feel they're being asked to sacrifice their profitability for the sake of moving product, and that's causing a significant rift between the manufacturer and its retail network. In some cases, dealers are feeling betrayed as the financial pressure is becoming too much to bear. What's worse, as dealers lose trust in the brand, it's likely that their customers will too. When a brand is constantly pushing its dealers to sell at a loss, it undermines the sense of loyalty and partnership that dealerships expect from their manufacturers. This breakdown in trust could have severe long-term consequences for Stellantis. A brand that can't maintain the loyalty of its dealer network is at risk of alienating its customers as well. If consumers get the sense that they're not getting a good deal or that the brand is unstable, it could drive them to competitors like Ford or General Motors, who may appear more reliable and stable in comparison. But don't think Ram is in the clear. The fallout from this shakeup could change the entire market for years to come. The state of the automotive market. Ram's sudden decision to slash prices by up to 35% has created a massive shift in the market. This move isn't just about clearing out inventory, it's reshaping how trucks, and eventually other vehicles, will be priced, sold, and valued. The immediate effects are already being felt, and they'll likely have long-term consequences that extend well beyond Ram dealerships. For years, trucks like the Ram 1500 have been sold at premium prices, and for good reason. People are willing to pay top dollar for these vehicles. But now, with an oversupply of unsold 22 and 23 models sitting on dealership lots, Ram is taking drastic measures to get them off the shelves. Dealers are being forced to drop prices by as much as 35%, sometimes even more, to make room for newer models. Now imagine this, a truck that was once priced at $70,000 could be marked down to $38,000, creating a massive price gap. It's a shock to both the market and the buyers, and it isn't just affecting Ram trucks. This pricing shift is setting off a chain reaction across the entire automotive market. When Ram, a major player in the truck segment, starts slashing prices, other brands like Ford and General Motors are bound to take notice. Consumers are naturally going to compare these huge discounts on Ram trucks with the prices of competing vehicles. If the Ram 1500 is suddenly much cheaper than a similarly equipped Ford F-150 or GMC Sierra, people are going to gravitate towards Ram. This consumer behavior will force other manufacturers to reconsider their own pricing strategies, possibly starting a full-scale price war that could reshape the market. What's happening here is more than just a pricing decision. Ram's strategy could lead to a complete overhaul of how trucks are priced and sold in the future. And while the current focus is on trucks, the ripple effects could eventually alter the entire automotive industry. But it's not just about the trucks. This could change how every consumer buys a vehicle moving forward. The digital dealership revolution. The rise of digital dealerships and online car sales is another factor that's changing the market. For years, dealerships have relied on their physical locations to sell vehicles, but more consumers are opting to shop for cars online. This trend has only accelerated with the rise of online sales platforms that allow people to browse inventory, compare prices, and even complete the entire purchase process without leaving their homes. The convenience of shopping from home has made digital platforms increasingly popular, and it's starting to influence how automakers and dealerships approach sales. In fact, many major manufacturers have ramped up their efforts to shift to digital sales, offering virtual showrooms and online sales tools that enable consumers to complete their purchases with just a few clicks. How does this connect with Ram's pricing strategy? As Ram slashes its prices, more consumers will turn to online platforms to compare deals. These digital platforms are gaining traction as consumers seek the best possible prices without the hassle of negotiating at traditional dealerships. As a result, traditional dealerships that rely on in-person interactions may start losing out if they don't adapt quickly. This digital shift is forcing traditional dealerships to rethink their sales models. If they don't offer competitive prices and transparent information, they risk losing customers to online platforms that can deliver better deals and a more convenient experience. But here's the bigger question. Will this push Ram to go even further in terms of their pricing model? If online platforms gain even more traction, Ram might find that aggressively lowering prices can help them dominate the digital sales space as well. The future of Ram. What's next? If you think Ram's done shaking things up, think again. Ram's price cuts aren't just a one-time event. They're a part of a broader strategy that could continue to evolve. For now, we're seeing them aggressively cut prices to clear out inventory and take a larger share of the market. But once the market stabilizes, will Ram continue to push these drastic price cuts, or will they adjust their strategy? And there's a lot at stake here. Ram is playing a long game, and if they can establish themselves as the go-to brand for budget-conscious truck buyers, they could solidify their position in the market. However, this strategy isn't without its risks. If they continue to lower prices too aggressively, they could alienate higher-end buyers who are looking for premium features and finishes. Additionally, if Ram exhausts its inventory of older trucks to slash prices on, they might face challenges in maintaining these lower price points on new models. At some point, their pricing power may diminish, and they'll have to figure out how to adjust to avoid devaluing their brand. The future for Ram is still uncertain, but one thing is clear: this strategy has already had a huge impact on the market, and the repercussions will be felt for years to come. What does this mean for you? Imagine if the truck you're eyeing right now was 30% cheaper in a few months. As a consumer, you might be wondering, what does this mean for me? Should I buy a truck now or wait for more price cuts to come? The reality is that timing will be key. With Ram's price cuts already shaking up the market, there's a chance that other automakers will follow suit. If you're thinking about buying a truck, it might be worth waiting a little longer to see if prices continue to drop. However, there's a catch. As prices fall and more consumers turn to digital platforms to buy trucks, the buying process could change. Dealerships might move toward a more standardized pricing system, which could take away some of the flexibility and negotiation opportunities that consumers have enjoyed in the past. So what's the best course of action? The key is staying informed. Watch for price trends, stay on top of market shifts, and be ready to act when the right deal comes along. This is a unique time in the automotive market, and the next few months could offer great opportunities for savvy buyers. But while this might seem like an opportunity, there's one last major challenge to consider: the economic fallout. What happens when a $60,000 truck becomes a $30,000 truck? The economy will feel it, and not in the way you might think. This massive reduction in truck prices is more than just a headline. It's a tidal wave that will send shockwaves through the entire automotive industry. Let's take a step back and consider the broader economic impact of these massive price cuts. First off, we have to think about how this move will affect consumer spending. When trucks, which are often considered significant investments, suddenly become half the price, consumers will be in a frenzy. People who were once on the fence about buying a new vehicle may now find themselves in a position where the value is too good to pass up. This surge in demand could temporarily boost sales, but it's not a sustainable long-term growth strategy. Consumers may flock to dealerships now, but once the initial wave subsides, the long-term effects may be more troubling. For dealerships, this creates a paradox. On one hand, it's a chance to clear out old inventory that's been sitting on lots for far too long, costing them money every day it remains unsold. On the other hand, these same dealerships are facing a razor-thin margin when it comes to moving these trucks at such steep discounts. The money that was once earmarked for profits is now being swallowed by massive discounts, special interest rates, and other incentives designed to move these vehicles off the lot. The economic strain is palpable, and dealerships are stuck between a rock and a hard place. But the true economic fallout won't be felt immediately. What's coming next is more insidious: a market downturn. The impact of this fire sale on new trucks is set to ripple through the used vehicle market, which will see its values plummet. When a consumer can get a new truck for the same price, or even less, than a used one, the demand for pre-owned trucks will disappear. This can cause a domino effect where the value of used trucks drops drastically, leaving those who bought them at a premium with an asset that's worth far less than they paid for it. Now there's a catch-22 at play. While consumers may enjoy the immediate benefits of lower truck prices, they'll likely feel the sting of negative equity in their vehicles over the next few years. People who bought trucks at full price will find themselves stuck in a situation where their truck's resale value has dropped drastically, leaving them with a debt they can't escape. This negative equity crisis will create a massive burden, not just on consumers, but on the broader economy as well. And if Stellantis continues to push these fire sales, it's not just one brand being impacted, it's the entire industry. So what's really at stake here? It's not just about the pricing strategy of one company, it's about how this unprecedented move could fundamentally alter the economic landscape of the entire automotive industry. The question is no longer whether these price cuts are a good idea. The real question is, how will this strategy reverberate across the market, and what will it mean for the future? The end of an era. For decades, Ford, General Motors, and other legacy brands have been the giants of the automotive world, leading the charge with their long-established reputations, massive dealer networks, and loyal customer bases. But what happens when a relative newcomer, like Ram, comes in and upends the entire market with aggressive pricing tactics? The risk is that Ram's new strategy could begin a domino effect, forcing these traditional brands to rethink their entire approach. Ford and General Motors are already struggling to adapt to the shifting landscape landscape of consumer demand, especially with the rise of electric vehicles and the growing appetite for tech-driven features. Ram's pricing model could accelerate this pressure, pushing legacy brands into a corner where they have no choice but to adopt similar strategies just to stay competitive. This isn't just about trucks anymore. Ram's approach to cutting prices could signal a complete shift in how manufacturers price and sell vehicles. As consumer behavior increasingly shifts towards valuing cost-effectiveness and immediate savings, manufacturers may have no choice but to follow suit. It could become a race to the bottom, where each brand continually lowers its prices to attract customers, creating a market where low prices are prioritized over brand loyalty or quality. But Ram's aggressive strategy might also create opportunities for a new breed of automakers. Smaller, more agile companies may take note of Ram's success and attempt to replicate its approach. These future automakers could attract a new generation of consumers, those who value price above all else, who are willing to trade traditional brand loyalty for immediate financial relief. This could spell the end of the dominance of legacy brands, replacing them with a new generation of manufacturers who understand that the future is about offering affordable, high-quality products for the masses. But one thing's for certain, the automotive world will never be the same. The rise of budget-conscious buying, coupled with Ram's new market tactics, could create an entirely new competitive landscape where traditional brands struggle to maintain their position. So, is this the moment for electric trucks? What if Ram's price cuts open the door for electric trucks to become the new standard? Electric vehicles have already gained momentum, and the truck segment has long been the final frontier in this green revolution. Ram's aggressive pricing could be the catalyst that accelerates electric trucks into the mainstream. After all, what good is a gas-guzzling truck when consumers are facing steep price cuts on new models, and the future is increasingly shifting toward electric power? This intersection of price cuts and growing demand for electric trucks creates the perfect storm. As consumers flock to dealerships looking for affordable options, many might start considering electric trucks as a viable alternative. While the upfront cost of an electric truck may still be higher, long-term savings from fuel efficiency, tax incentives, and reduced maintenance costs make them an attractive option. For many, it could soon be the smarter choice. The market for electric trucks is ripe for innovation. Automakers who want to compete with Ram's pricing will need to view electric trucks as a serious option. With more consumers becoming eco-conscious, the demand for green vehicles that align with their values is increasing. This could spark a new era of electric truck dominance, turning what was once a niche market into the new norm. If Ram's aggressive pricing forces other brands to follow suit, it could fast-track the transition to electric trucks, bringing automakers into a rapidly growing market. This shift toward greener, more cost-effective vehicles could redefine the entire industry, forcing both legacy and new brands to race toward a sustainable future. The question now is whether consumers and manufacturers are ready for this revolution. What's your thoughts on this? Let's know in the comments down below. Thanks for watching.